Most people think the safest thing you can do with money is leave it in the bank. And on the surface, that makes sense. The number doesn't go down, you can see it anytime, nothing dramatic happens. But the most expensive financial mistakes are rarely dramatic. They're quiet, they happen slowly, and by the time you notice them, years have already passed. One of the biggest examples of this is holding too much cash. In the UK alone, there's hundreds of billions sitting in low interest accounts, earning almost nothing. In the US, millions of people are doing the same thing, and most of them don't feel like they're making a mistake at all because nothing looks wrong on the surface. Not having some cash, that's sensible, but holding more than you actually need can slowly undermine your finances in ways you can't even imagine. So in this video, I want to explain why holding too much cash can quietly work against you, and more importantly, what you should be doing instead, without panic or complexities. Let's start with a simple idea. Cash does nothing. Think about how much effort it took you to make that money. You give up time, you give up energy, you deal with stress, deadlines, and responsibilities. You earn that money, you deposit it into your bank account, and then it just sits there. A year passes, you check the balance, the number hasn't changed. In one word, the value of that money is now worth less than it was before. That's inflation. Inflation doesn't announce itself. It doesn't send you a notification. It just quietly reduces the value of your money. The same £10,000 last year can only buy maybe worth £9,000 today. And it will even buy even less next year. So while you're working hard, your cash is standing still. Now compare that to what happens when money is invested. If that same £10,000 earns a modest long-term return, maybe around 7 to 8%, it starts to grow on its own. After 1 year, it becomes more than you put in. The next year, it grows again, not just on the original money, but on the interest as well. Over 10 years, cash stays the same. Cash stays cash, but invested cash compounds, and that difference isn't small. Over time, it could mean the difference between staying financially stressed and becoming financially free without working any extra hours. This is why keeping excess cash comes at a cost. It's not neutral. It's a decision that quietly limits what money can become in your hands. At this point, you might be thinking, but I need cash for emergencies. And you're absolutely right. Emergency fund is important. But here's where many people go wrong. They save far more than they actually need and call it being safe. The purpose of an emergency fund is very specific. It's there to cover your core living expenses if your income stops. That means housing, foods, utilities, minimum debt payments, essential transport. That's all. Not holidays, no lifestyle upgrades, nothing, just survival expenses. Once you calculate that monthly number, the standard guidance is simple. 3 months for stable employment, 6 months for extra security, up to 9 months if income is unpredictable. But that's it. Anything beyond that is not protecting you. It's usually just keeping your money there for no reason, for fear, uncertainty, or indecision. I've seen people with a lot of money claiming it's all emergency fund, only to realize more than half of it has no clear purpose. It wasn't planned, it wasn't allocated, it was just there. And money with no plan always ends up being misused or underused. Emergency funds are one of the most misunderstood ideas in personal finance. They're not meant to make you feel emotionally comfortable. They are meant to solve a very specific problem: income interruption. The question an emergency fund tends to answer is simple. If my income stops tomorrow, how long could I cover my essential costs without, struggling? That's it. When people say far beyond that amount, it's usually not because they need it. It's usually because they haven't decided what the money is actually for. Money without a plan tends to default to cash, and cash without a purpose tends to sit indefinitely in the account. Now, here's a side effect people hardly think about. When you see a large balance in your main account, your brain treats it like spending money. You tell yourself, oh, I can afford it. I have some spending money left. It's fine. And slowly spending creeps up. Not because you're irresponsible, but because the money is visible. And when it is visible, it feels available even when it's meant for something else. This is why separation matters. When money is automatically moved into savings, investments, or goals specific accounts, it stops being part of your daily decision making. People who build wealth don't rely on willpower, they rely on structure. That is why, as a person who is serious about your finances, you need to have a money structure you can and you should rely on. Another misconception is that cash has no risk. It does. In both the UK and the US, there are limits to how much your bank account can cover with protection if something goes wrong. And if you exceed those limits in one place, you're taking unnecessary exposure. That means if anything happens to that money, there is no insurance that you're going to get it back. The real risk is time. Cash is fine for short-term goals, but is not relevant for long-term goals. And if you keep it, inflation becomes a bigger threat. Market fluctuates in the short term, yes, but over long periods, growth has historically outgrown all of those fluctuations. The reason people cling to cash is the belief that cash carries no risk, but that is not true. Risk isn't just about loss, it's also about missed opportunity. There's the risk of inflation, the risk of concentration, the risk of delay, and over long periods, these risks are often more damaging than market fluctuations, especially when money is invested gradually, broadly, and with a clear time frame. Markets move, yes, but life moves faster. Instead of asking, is cash safe? The better question is, what is this money for? And when will I need it? If the answer is soon, keep it. If the answer is uncertain, define the uncertainty. And the answer is fine in the future, please let it grow. Money becomes powerful when every portion has a role. A simple way to think about it is, think of your finances as a system, not a pile. Some money is for stability, some money is for goals, and some money is for growth. When everything sits in one place, it all behaves like spending money, and none of it works efficiently. Because yes, structure creates progress. Keeping some cash is very important. Keeping too much is costly. The goal isn't to afford risk. The goal is to avoid unnecessary risk, including the silent risk of doing nothing. Your money should be working as hard as you're working, not standing still doing absolutely nothing while time passes. If you found this video helpful, please give me a like and subscribe to my channel. This channel is about leveling up financially by learning about money, career, and side hustles. Thanks for watching, and I'll see you in the next video.